Okay, hey guys, we're getting ready to get started here. First of all, if you have any questions about anything to do with Cantor Exchange, you can contact AJ Grossbart. Here is his email address. Also, you can call him right here, 212-829-7114. If you have any questions about Traderbot Marketplace or any of our products, you can send me an email here at help@Traderbot Marketplace, or find us on Facebook or just Google us, whatever, and you will find us. Okay, let's hop right into it. Today, we are going to be talking about dual touches and dual expiries. Let me go ahead and get this part out of the way. CFTC required trading disclaimer. The risk of loss trading any financial instrument, such as Forex or binary options, can be substantial. You must be aware and willing to accept those risks in order to invest. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy or sell any financial interest. No representation is being made that any account is likely to achieve profits or losses similar to the ones discussed here. Past performance is not indicative of future results, and any strategies discussed are for educational purposes only and are not to be construed as specific trading advice. This material is for educational purposes only. Okay, I see a couple of new people in here. Welcome. We do these webinars about once a week. We also do little private webinars throughout the week, so if you ever need any help with a private webinar, just let me know. If I have time, I will do it for you. Okay, so let's look at something right here. We're going to talk about dual touches and dual expiries, but first we have to understand what is a dual touch and a dual expiry. Okay, a dual expiry, some people call them, you can call them butterflies if you want them to expire inside a certain area, or you can call them straddles or strangles if you want them to expire outside of a certain area. So let's take a little box here. Let's pretend that this box represents a trading time, the beginning of a contract over on this side, and the end of the contract, such as 1 p.m. or 2 p.m. or whatever, over on this side. And let's set, we could call it a floor and a ceiling. Let's say that we want price to expire in this little box for whatever reason. If price opens up right here, before I go any further, Hamid, we are talking about binary options through a CFTC regulated trading exchange called Cantor Exchange. The things that I will be talking about can also be used in the Forex market for the most part. Okay, so let's say that price opens right here. Now we can't see all of this, all of these bars over here because they haven't happened yet. It'd be kind of like looking at the screen, and this is all we see. We can't tell the future, but what we do know is we want price to either expire below this area right here or above this area right here, at least, by expiry. Now, did this one do it? No, it didn't. It kept going down and just trending down and expired below the box. However, the majority of time, and actually it's about 80% of the time, the market is in a range called, it's not trending, it's in a range. You can see that here, you can see that down here, you can even see that right here. And 20% of the time it's trending, such as it's going down, it is going up, and it's moving in a direction. There are a few things that's trending right now, such as the stock market. It's been trending for, Lord, who knows how long. That's in a trend. There are things that are not trending, such as, well, I don't know right now. I'd have to look at it. But then you have to scale it down. You can't just look at like a daily chart. You want to look at an hourly chart, 15-minute chart, 5-minute chart, because a trend is always relative to the chart you're looking at. Something may be trending on a daily chart. Let's look at a daily chart. Okay, we see this uptrend right here on a daily chart. You can clearly see that it's in an uptrend. So if I had to ask you, okay, what are you going to do? Are you going to buy, or are you going to sell this for some point in the future? Well, you're probably going to buy. Let's just say you're going to buy. Now we can go down and we can start looking at an hourly chart. Now we see right here, it's still in an upward trend, but technically there's a lot of places in here that is a range. It would be considered a range, such as this area right here, this area right here, and we're not going to know that until after the fact. But there are times of the day when the market does not trend as much, and that's what we're going to be looking at today. We're going to try to try to find some areas when the market is not trending. One of the times during the middle of the day that the market seems to not trend is after lunch. A lot of the traders in New York are going to lunch, you know, with their sweethearts or whatever. The traders in London are actually going home. They're done for the day. So after lunch in the New York session, the markets usually fade off of a trend. If they've been trending all day, after lunch, they're most likely going to stop trending as much. Let's go down to a 5-minute chart. Okay, you can see right here. Here, you know, this morning from, I don't know, from 4:30 on to about 10:30, it did a little trend. Then it did a little trend here. Now, after lunch, what does it do? It does nothing. It kind of sits there. So if I wanted to look at this and I wanted to say, okay, I want to place a trade in here, but I don't know what to do. I don't know whether to buy and I don't know whether to sell. But I know after lunch, the market usually does not continue trending. If it does, it doesn't trend as hard as it did before lunch. So I want to look at a place to buy or sell in here. Now, since I've got all that down, hang on a second. There we go. Since I've got all that down, I'm going to open up my tool suite. Let me see here. Hamid, this is one other indicator that I did not show you today, and this is what the webinar is going to be about. So I'm going to open up the tool suite here. Now, what does the tool suite do? It shows us probabilities that price may or may not do a certain thing. We're going to go in here and look at something called a dual expiry right now. Dual expiry. I'm going to set this right now. We're looking at something called a bar run. And just to recap what a bar run is, for those of you that don't know, a bar run would be something like this. Right here, let me take this off. Right here, we've got 4 bars. These are hourly bars. We got 4 bars. 1, 2, 3, 4. 4 bars in a row. This is called a 4-bar run. Right here, we got 2 bars in a row. 2 blue bars. Blue, blue. That's a 2-bar run. Right here, we got 3 bars in a row. 1, 2, 3, 3-bar run. So what we're going to do is we're going to just look at, let's say a 2-bar run. We want to look at a 2-bar run and try to find out what the probabilities are that price is going to close inside an area. Got it set up on dual expiry. Now let me go set it to a 2-bar run. Okay. Now right here, I can see, and I've got to set these to Cantor Exchange expiries. 1 second. Cantor Exchange expiries are 5 pips wide, so that's what we're going to set ours on, 5 pips wide. Okay, so the first thing I see here, I see some arrows. And I don't know what the arrows are for yet, so I'm going to tell you that. See this arrows? See this arrow? With a dual expiry, this arrow means nothing. It means nothing because the only thing that we're looking at right now, we're looking at price to either expire below this line right here or above this line. We want price to expire in the middle. Now, how often does that happen? Well, let's look over here. Wait a second, it only happens 20% of the time. So you mean to tell me that if we're looking for a trade to expire in the middle here upon expiry, that only happens 20% of the time? Do I want to do that? Do I want to take that trade? Lord, no, I don't want to take that trade because if it only happens 20% of the time, then what happens 80% of the time? It expires outside of these areas. So if I know that, I'm going to go look at my other expiries. Now I know that if I go the next strike out, and I'll look at this on Cantor Exchange too. If I look at this, the next strike out, wherever price opens in the middle here, we're looking at either 2 strikes up or 2 strikes down. That's what we're trying to find. Now, at the end of the day, right now it's 3 p.m. There may not be any strikes available. But earlier in the day, like right after lunch, there usually are strikes available. So what I want to look at doing is I want to look at selling the upper strike. I want to look at, okay, hang on a second, Dylan. I want to look at buying the lower strike because what happens when I sell the upper strike and buy the lower strike? Well, I might risk, you know, I might risk 80 to try to make a profit of 20 if I sell up here. And I might risk, you know, 80 again to make a profit of 20 if I sell down here. But guess what? Both strikes cannot, it's mathematically impossible for both strikes to lose. You're going to win one of them. If the market goes up, you're going to lose this one here, and you're going to win this one down here. If the market goes down, you're going to win this one up here, and you're going to lose this one down here. You're not going to lose the full 80 though, because what you're doing is you're putting up a risk, a total risk of 160. But do you actually have that risk of 160? No, you don't. You only have a risk of 80. That would be the most you could possibly lose, even if the laws of mathematics broke down and you lost both of them, which cannot happen. So what happens if the market, if I sell a strike up here and I buy a strike down here, what happens if the market just, takes off and moves up faster than we can catch it? Well, I'm going to lose 80. And then down here, I'm going to make 20. So how much have I actually lost? 60. So that is my maximum risk technically is negative 60. Is everybody following along? So if you're trying to buy what's called a butterfly, and you sell the upper strike and you buy the lower strike, and you lose a trade, your risk is negative 60. If price, let's say price does expire inside of the two strikes, how much do you win? You win 40, because you're going to win both of them. You're going to win the upper strike and you're going to win the lower strike. So there's only two things can happen. Price can expire inside. Price can expire outside. It's binary. It's those are the only two things that can happen. Now, if I'm looking at this and I see we've got a 20% probability that price is going to expire below this line and above this line, maybe I want to do a straddle on that. We talked about a straddle a few weeks ago. So that's on YouTube. You can go search for it. I'll put it up here in a few minutes. But if you choose a strike farther out, which has a higher likelihood of expiring below the area up here or above the area down here, you're going to have a higher likelihood of that trade winning. Let's go look at another example. Give me just a second. Dylan, I will answer you in private about that because it varies. Okay, so now let's say I'm looking at this and I want to place a trade. We're going to look at what's called a dual touch. There we go. Now on a dual touch, what we're looking at is how often does price touch both? How often does price touch? Let me clean this up 1 second. Give me 1 second. Oh, I just lost it. Guys, I have a technical issue. Hang on just a second. Sorry. There we go. So if I'm looking at this right now, I can see that I have a 61% probability right here, 61% probability of price touching both this line or this strike and this strike, both of them before the end of the hour is out. That's what the probability is. It's 61% that it's going to touch this one and it's going to touch this one. Now in Forex, that's a little bit more relevant than it is in binary options. However, in binary options, you can still get out of your trade. Since the risk is limited, whatever you put up for your trade is the most you can possibly lose. So if I'm buying, let's say, an out of the money, I want price to go up here and I want it to touch this area. Then I want to get out at a profit if the bid and ask will allow it. And I'll also want to sell this strike down here and I want to get out at a profit if the bid and ask allow it. That's taking to what's called an OTM trade, an out of the money trade. You're risking a little bit. You want price to move up and touch this line and price to move down and touch this line. Now, the only bad thing about it is when you're going with only the two strikes above, the strike above and the strike below where price opens, when price moves up to that strike, you may not always be able to get out at a profit because it's too close. One way you will be able to get out at a profit is if it's later in the contract. Because whenever the contracts move, let's go over to Cantor Exchange. whenever the contracts move, they don't move in a straight line. For instance, if I've got, here's our straight line. Let me see if I can figure out how to explain this. Okay, if I'm trading a strike, let's look at this area right here. And I'm trading a strike. Hang on. Sorry. If I'm trading a strike that's, say, right here, here's the strike, here's the end of the contract here, whatever. And let's say the price remains under the strike and prices, it never goes above the strike. Now, this binary options contract is going to degrade over time, over the life of the contract. Now, I've got a straight line here that would show like a hypothetical if it degraded at the same amount of time over the life of the contract, but that's not the way binaries expire. Binaries expire more like this. They won't move very much during the first half of the contract, but then as the contract gets toward the end, they're going to start moving in what's called a parabolic fashion. What do you call it? It's a curve of some sort, and I cannot remember the scientific name, but that's the way binary options degrade over time. Does everybody know what I'm talking about with the way binary options degrade? If you do, let me know. If you don't, no. Okay, let me try to explain it like this. Let's say, let's just use a live chart right here. I'm going to take this trade right here at 8. I know it's not a great trade. I'm just going to take one contract. Okay, now I'm in this contract here. Where did I go? Where am I at here? 1900. Let me try it one more time. There we go. All right. I want to get in this contract here. Okay, we're in the contract. I know I paid a little bit for it. I don't care, whatever. So technically, this is a stupid trade. Don't do this. Technically, I am risking 91 to try to make 9. Now, why did I do that? Well, I know that the strike is up here. The strike is right there. Now, I also know that if price stays where it's at until the end of the contract, which is in 42 minutes or so, if price stays where it's at and does not move, my profit here, which is at a loss right now, of course, but my profit is going to remain relatively the same for the first half of the hour. Let's see here. Price is going to remain relatively the same for the first half of the contract. If price never moves, it's just pretty much going to remain the same. I'm going to be at a negative 17. And then toward the end of the contract, the price is going to degrade, which means my profit and loss is going to start going up, because if price does not reach up here to my strike toward the end of the contract, then all of the other prices that the market maker is going to offer is going to get lower and lower and lower. And it's going to get lower and lower and lower faster toward the end of the contract, toward the second half of the contract. So the first half remains relatively the same. I'm just doing that to separate this half and this half. The first half remains relatively the same, and the second half will degrade much faster. So if I sold this at 6, and price never moved, I can probably still sell it at 6 for another 10 minutes, maybe another 15 minutes, but at some point that price is going to start degrading. They're going to start offering it out at 5, offering it out at 4, then 3, and then, and on down. So if I'm going to get in, if I believe price is just going to sit there and not really move, it is better for me to get in at the beginning of the hour when the price is better, because we know price is going to degrade. The farther along in the contract that we go, the worse pricing we're going to get. Do you understand that? Yeah, Dylan says, yep, you're going to make money or lose money faster and faster, and that's true. Whenever you look at the way an hour binary, yeah, it's kind of like buying more time with regular options. Okay, for instance, I was looking at an option today, a traditional option on the options market, as a asset protector in the event of a market crash next year. I was looking at the pricing, and my gosh, they're expensive. I mean, they're somewhat reasonable, but they're really expensive right now. Why? Because I'm looking out 9 months from now. So they are a little bit more expensive, but that's binary, or that's options and binary options for you right there. So anyways, let's go back to the tool suite. So I know we've got a 61% probability of price touching this area and this area. I also know that we have a 18% probability of price touching up here or down here during the length of the contract. Now, if I want to go in here and I want to say, okay, that's too close. I want to go for, like, I don't know, a daily contract, or maybe even over the next 12 hours or so. I'm looking over the next 12 hours and I can look at the Euro USD. Now, when this signal came out on this bar right here, I knew, I knew the price had a 19% probability of both touching this line up here and this line down here. It had an 80% probability of not. Well, as the laws would have it, it did both today. It went up and touched this, and it went down and touched this also. But let's look at expiries. What's the expiry on that? I'm going to go in here and I want to do a dual expiry. I know that it had a 45% probability of closing inside of this box. Guess what? I had a 54% probability of it not doing it, and it did not. It closed outside of it. So these are stats that you always need to look at whenever you're looking at a trade. You always want to know the stats on, whatever it is that you're looking at. If you're looking at one bar, you need to know, what is my probability? How often is that going to pay off, or how often am I going to take a loss on it? When you know these probabilities, and you go in there and you start looking at the market every day, it's going to let you see the market in a whole new way. We got a guy in here named Dylan. I've been working with Dylan for a while. He uses the tool suite, and that's what we use for signals and everything all the time. Now, Dylan, can you, after playing with this for, I don't know how long you've been with us now, are you starting to see the probabilities, and are you checking, I check mine probably 100 times a day over different assets and different time frames. And I don't even know if you're in here, but if you are and you want to mention anything about how you look at your charts, go ahead. Long story short, you can't come into the market, in any market, whether it's on Cantor Exchange or whether it's on any other market in the world, and look at the chart and say, well, this looks like it's going to go up. Every time I hear somebody say that, I like to come back with, based on what? You cannot trade from your gut. I mean, I've lost so much money trading from my gut over the years. Whether you have a fundamental analysis, which is looking at interest rates, things like that, or whether you have a technical analysis, which is looking only at the charts. Look at something. Have a reason why you're getting in or getting out of the trade. Now, Cantor Exchange has offered a way to get into the market and trade with as little as $1. So trading with as little as $1, people ask me all the time, does Cantor Exchange have a demo account? No, they don't. They have $1 contracts. And actually, you're not even risking $1. You can risk as little as 5 cents, if you're trading out of the money. And in my professional opinion, demo accounts, how can I put this nicely? Demo accounts have done more harm for me than a small live trading account at Cantor Exchange has done, because I know whether I'm trading $1 or whether I'm trading, $100, I know I'm trading live money, even though it's very small. And you don't want to trade, large until you know what you're doing. But it's better than a demo account, in my opinion, because not only do you feel the ups and downs of the market going up. Even though look, I know that if I were to close this right now, I would lose 15 cents. But psychologically, that would be a loss on a live count, or a win if it's up. You know, just make sure you know the probabilities of what you're doing. And when you've got that, when you know that this bar right here has X probability of happening, then you're more confident in placing that trade. So, okay, do we have any questions so far? Hamid came into this webinar. I met him today in a little chat session, and I invited him in here. So Hamid, I don't know if you trade binaries or not, but if you have any questions about the Forex market, you can ask those as well, because all a binary is a derivative from a, okay, all a binary it's a derivative of the Forex market. The price is derived from Forex. They move differently. They're what's called, they're binary because, I'm going to do a little quick tutorial for Hamid here. They're binary because in the Forex market, if you, okay, I'm going to pull up a chart here. Hang on. And I'm going to show you why binaries can be more effective than the Forex market. Now, if I'm looking at this chart and I bought right here in the Forex market, let's say I bought right here, depending on how many I bought, you know, one standard lot or whatever, and then price fell all the way down here, and I'm still holding on to it because in Forex you don't have an expiry like you do in binaries. So I'm holding on to it, and I get down here and I just can't take it anymore. My account's down, I don't know, some ungodly amount, so I get out. You know, I'm looking for this price to go long. Now, how much did I lose from here all the way down to here? I lost probably a lot. How much would I lose if I were trading a binary? I would lose only, let's say I placed what's called an at the money trade. And I know you don't know what that means yet, but just go with me for a minute. Let's say I placed an at the money trade and I risked 50 cents. 50 cents. How much would I lose if price went all the way down here? I would lose 50 cents. I can't lose any more than that. There's no way, because these contracts are, they're all, what do you call it? What's the name of it? Oh, I cannot think of the name of it, but you cannot lose more than you put up for the trade. If you put up 50 cents for the trade, that's all you can lose. Now, how much can you make? 50 cents. Why? Because every single contract, equals 100. So if I know that every contract equals 100, and I want to buy a contract for, say, 80, then how much can I win? If I risk 80, how much can I win? Anybody? Somebody give me an answer. If every contract equals 100 and I risk 80, or I put up 80 out of that 100, yes, Terry, you're correct. You can win 20. How much can I lose? How much can I lose? What is my maximum amount that I can lose? 80. Correct, Terry. Let's turn it around. If I buy what's called an out of the money and I risk 20, how much can I make or lose? It's reversed. If you're risking 20, you can make 80 or you can lose 20, and that's all. That's the only two outcomes that you can have. Well, okay. Technically, there is one other outcome when price is identical to the price you got at in, so there's kind of like a split there, but that happens like 0.001% of the time. So just the fact that every contract is gosh, I cannot think of the word. Collateralized, pretty much. Every contract is collateralized, so you can't get a margin call ever. Now, what do I mean by trading an out of the money or an in the money? Well, to do that, I'm going to show you this. Scroll back in here. Okay, now I traded what's called an in the money. I risked 91 cents to try to make 9 cents. Now, why? Why on God's green earth would I do that? Because price is up here. Price is already in the money. It does not have, if price sits there and does not move for the next 30 minutes and 24 seconds, I'm going to win my trade. I'm going to win 9 cents. Now, can I retire off 9 cents? No, I cannot. However, there are contracts, and you can see the amount of contracts available: 4,810, 512. these are the contracts available. So you don't have to buy just one or sell just one. Now that's why I would risk more, and price may shoot up here. That's not a normal trade I would take, you know, whatever, just go with me for a minute. Price can shoot up here and price can close. It's kind of, price can shoot up here and close right there. One tick under my strike. And guess what? I get the full payout. I will make my 9 cents. Price can go up here and shoot far beyond my strike. And then at the last minute, which happens quite often, at the last minute come down and close below my strike. How much will I win or lose? I'll win because it closed underneath my strike. So Hamid, another note is, because you've never traded binaries and this is brand new for you, I want to warn you big time. There are only 2 places where you can trade CFTC regulated binary options. One of them is Nadex, one of them is Cantor Exchange. All of the other ones out there are not real. They are not real. The only 2 are Nadex and Cantor Exchange. So if you're looking at, and no matter what they say online, if you're looking at anything else online, I've got a ton of videos that you can watch to prove against that. So, okay. Do we have any questions about what we talked about today? If you do, let me know. If you got anything you want to talk about, let me know that. Oh yeah, I'll send you a link. Actually, give me your email. I'm going to send you some stuff after the webinar is over. And I'm going to have AJ reach out to you as well. So there we go. Okay, thank you very much. Okay, I just copied that so I can send that to you. But anyhow, if you have it, or you or anybody else have any questions, let me know. And that is all that I have for today. Talking about dual expiries, which happens quite often, and you can minimize your risk, and dual touches, which doesn't happen very often, but it's going to cost less than you would normally pay for a trade. So, oh yeah, Hamid, I will send you. Okay, that's fine. I'll send you. I'll send you a ton of information. So, and that's the webinar, guys. Hey, by the way, the end of the year is coming up. Now, I'm going to be doing some psychology webinars over the next three times we meet. Next week, I'm going to be talking about the #1 reason that traders fail. The #1, it's the reason that I blew out 9 accounts when I started. I don't know what else I'm going to be talking about next week, but it's going to be awesome. I love talking about trader psychology. If you want to come next week, do some homework. Go on to, where's it at? I want you to go onto YouTube. Or just, let's see here, videos. Stanley Milgram, we're going to be talking about him next week, the Milgram experiments. I want you to study up on this so you'll know what we're talking about next week, because we're going to get into some psychology. Now, the Milgram experiments were some pretty weird things that happened a few years ago, and you can research on that. Okay, Hamid, I'm going to send you that, and that is all that I have. I'm going to leave the webinar running. And if you have any questions, just type them into the chat. I appreciate you guys being here each week. You're awesome. Thank you very much. I will talk to you soon. Oh, hang on. And the current webinar link. Oh, Hamid, I'll send you all that in the email. Look for it in about an hour or so. I'll put it all together. All right, thank you. And everybody else, thank you. I'm going to go ahead and mute my mic. And if you have questions, type them in there. If not, we will end this here in a few minutes. Thank you. Bye-bye.